Cisco Systems Inc., ticker symbol CSCO, is currently trading at $48.57 a share. It is down about 11% over the last year, but we're going to see if this is the right time to buy. We're going to be looking at my stock valuation spreadsheet using discounted free cash flow model, the Ben Graham formula, and the comparables company model to see if this stock is undervalued. So if we have a look over the last year, as I said, it is down about 11%. If we take it back to the last 5 years, it is up 7%. The stock has been pretty up and down. It's a very stable stock, pays a very good dividend of 3.21%, a go-to for dividend investors. But you can see at the lowest of the pandemic, it only hit around about $35 a share. So it is up quite a bit since then, but that is the lower to go. If we look at the chart all time, a very different story. This stock was up 60,000%, absolutely crazy, but still hasn't reached the heights of the dot-com bubble of over $80 a share. Just talking about the dividend quickly, it is one of the highest paying dividend stocks in the NASDAQ 100. You can see it here with a 3.2% dividend. So I'll be talking about that actually right now. If we look at my stock summary sheet, if you want the dividend, buy this stock before the 4th of April, as that is the ex-dividend date. Right, let's get straight into it. So is the PE ratio less than the market? Yes, it is. Cisco has a low PE ratio of 17.8, which is below the market average. Next, you want to have a look if the revenue is increasing, and you can see here, as I said before, Cisco is a very slow growing company, but with good revenues, 49 billion to 53, and it has been steadily increasing over the last 4 years. Next, we want to have a look at the profit, and the profit has once again gone up, but barely, up almost 100 million, 11.2 to 11.3. Down a bit from the prior year, 11.8, but once again, profitable and growing. Now we want to see if they are issuing more shares, and no, they are buying them back. 4.4 billion to just shy of 4.2, and they've been steadily buying back shares the entire time. Now, once again, if we look over the chart, it hasn't really been a good or bad decision really, because they're rewarding shareholders. It's not like they're buying back shares when it's up or issuing more shares when it's down. It's been a pretty level stock, so they're rewarding shareholders overall, which is what we like to see. And finally, we'll have a look at the free cash flow. Yes, free cash flow is up again, 14.6 billion to 15.4. Had a strong bounce back, actually up 3 billion from the prior year, so that is good to see. So a perfect stock, pretty much from the summary here. Free cash flow ratio of 12.88. So when we look at the discounted free cash flow model now, I have a sneaking suspicion it will actually like Cisco. So what we do here is we look at the discounted free cash flow model. It's a valuation method that estimates the value of investment using its expected future free cash flows. We determine the value today based on what we think the company will generate in the future. So I've estimated the future free cash flows, and we'll discount them to today's value, and that actually gives us a value of $58 a share, meaning it's trading at a 20% discount. Now, if we go back to the stock, when was it trading about 58? Well, the start of this year, last year, 2022. Now, let's just have a little look at the numbers here. We want to see if it is in sort of reasonable estimates. First, we'll look at the revenue. We've got averages of 3.5%. Analysts are expecting a better year in 23 and 24. So we will bring this average up slightly higher. I think this will probably take out the 2020, obviously the pandemic year, which was a bit of a hit. So that brings us at about 4%. Now this brings it up to a $59 stock. Next thing we do is look at the net income margins. I think those net income margins are fair. I don't want to be tweaking those. And then also the free cash flow net income margin. So I'm pretty happy with those estimates. It brings the stock to $58.98 a share. Please give a like on the video. Try and get this video to 10 likes. I think that's my goal at the minute. And if you can keep on doing that, well, I'll keep on releasing videos. I'm going to try and release videos Monday to Friday each week, maybe with the occasional Vanguard update on Saturday or Sunday, because I know some of you guys are asking for that. Now we have a look at the Ben Graham formula. Now this is a formula for valuation of growth stocks created by the father of value investing himself, Ben Graham. So what this does is it looks at the company's 12 months earnings per share. It compares it to a P of a no growth company. The current P of this is revised formula, so it's 7, based on the expected growth. Now this was a much more extreme growth number, so the revised formula is now 1, and then with a triple bond yield, which is the average, which is 4.4, divided by the current bond yield. So let's have a look at the growth estimates for Cisco right now, looking at analysts, and they're expecting over the next 5 years to be better than the last 5 years, so 7.32%, which we have added here, and then AAA bond yield, which has obviously shot up recently because it is 4.56 back then. We'll put that number in actually out of interest, where it was 2.25, but we'll put that in once we've had a look at our initial valuations. So what does this give us? A estimate? Well, it gives a fair value of the stock at around about $57 a share. So obviously that is slightly higher than where it is right now, because, sorry, a lot higher. The stock is about $48 a share. So this is actually strong buy. And the grain price, which is a margin of safety, is 42.75. So the discounted free cash flow model stock, that didn't make any sense. The discounted free cash flow model gives the stock a buy. The Ben Graham formula also gives it a buy. Oh, and actually what I said is, let's have a look if it was 2.2%. If the AAA bond yield was what it was back in 2020, this stock would be an absolute no-brainer buy. But with that, it brings the price down quite a bit, which shows why this is a key thing that he put in the formula. So finally, we are going to look at the comparable companies model. Now, this is a way of valuing the value of a company using metrics of the company in question, and then businesses of similar size in the same industry. So what I've chose here to compare against Cisco is a couple here, which is Oracle, Intel, and IBM. We might compare with Microsoft, to be fair, at the end, but I think these are much fairer in terms of equity value. So what this does is it brings out a series of metrics here: the EV to revenue, which is the enterprise value, market cap plus net debt, which gives you the enterprise value, revenue, which obviously we know about. Then the next metric is EV to EBITDA, and EBITDA is earnings before interest, taxes, depreciation, amortization, and then finally PE ratio, which is price to earnings. If we have a quick look at the EV to revenue, what we want to see here is the lower the better, and if we compare it to a company that's about the same size, Oracle is the highest with 6.1, Cisco is 3.9, a lot higher than Intel and IBM. Next, we want to look at the EV to EBITDA, the lower once again, and this is pretty much in the middle of 13.2, and PE once again in the middle. So we will look at some of the averages here. I'm taking the averages, I'm using these in my calculations, and then this gives us implied value per share for each one of these metrics. So as you can see, $48 a share is what it's currently valued out, and the three metrics give it 46, 46, and 53. So it gives an implied value of around 48. I think the reason why the P is a little bit higher is because we're looking at the average, and IBM is a lot higher. So if we just take out the compare it to the median here, which would be 11. You can see that drops it down a bit because I think the IBM PE ratio is a little bit out of whack compared to the other ones. So it puts the stock pretty much fairly valued based on the comparables model. Right guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and I'll catch you guys next time.